Welcome to our Introduction to Volatility Indicators. These are essential tools in a trader's technical analysis arsenal. Volatility indicators are technical analysis tools that measure the rate of price movement in financial markets. Unlike other indicators that focus on price direction, volatility indicators measure the magnitude of price changes, regardless of whether prices are moving up or down. The key difference between volatility and trend indicators is their focus. While trend indicators show price direction, volatility indicators highlight the intensity of market movement. Volatility indicators serve several important purposes in trading. They help traders assess market risk, identify potential breakouts, and make more informed trading decisions. Understanding volatility is crucial because it helps traders gauge market sentiment and adapt their strategies to changing market conditions. Volatility measures the rate and magnitude of price changes in a financial market. Low volatility markets show gradual, predictable price movements with small fluctuations. In contrast, high volatility markets exhibit rapid, significant price swings that can create both opportunity and risk. Volatility directly impacts risk management decisions in trading. In low volatility environments, both risk and potential reward tend to be lower. During high volatility periods, both risk and potential rewards increase significantly. Volatility is a key factor in determining appropriate position sizing. In low volatility markets, traders can typically use larger position sizes due to more predictable price movements. However, during high volatility periods, reducing position size becomes crucial to manage increased risk. Market volatility should directly influence your choice of trading strategies. Different strategies perform optimally under specific volatility conditions. Trend following and mean reversion strategies typically perform better in high volatility markets, where significant price movements create stronger trends and overextensions. In contrast, range trading strategies excel in low volatility environments, where prices tend to stay within defined boundaries. Scalping becomes particularly profitable during high volatility periods, but can be challenging when markets are quiet. Changes in volatility often signal important market phase transitions. Markets typically cycle through periods of high and low volatility. Low volatility periods often represent established trends with steady price movements. Decreasing volatility frequently indicates market consolidation, as prices compress into a tighter range. The most significant opportunity often comes after consolidation, when volatility increases dramatically during breakouts, leading to substantial price movements. Understanding and monitoring volatility is essential for traders. It helps you manage risk effectively, size positions appropriately, select optimal strategies, and anticipate significant market moves. The average true range, or ATR, is one of the most widely used volatility indicators in technical analysis. Developed by J. Wells Wilder in his 1978 book, New Concepts in Technical Trading Systems, ATR measures the market volatility by calculating the average range between high and low prices over a specified period. Understanding the true range is the first step to calculating the ATR. The true range is defined as the greatest of these three measures. First, the current day's high minus the current day's low. Second, the absolute value of the current high minus the previous close. And third, the absolute value of the current low minus the previous close. The true range is the maximum value of these three calculations, capturing gaps and limit moves that would otherwise be missed. Let's visualize how ATR works with a price chart over 20 trading days. Here we see a stock price moving with various levels of volatility. Below the price chart, we can see the corresponding ATR indicator. Notice how the ATR increases during periods of higher price volatility and decreases during calmer market conditions. The average true range has several practical applications in trading and risk management. First, ATR is commonly used for setting stop-loss levels. By placing stops at a multiple of the ATR away from entry, traders can account for the current market volatility. Second, ATR can guide position sizing decisions. In more volatile markets, reducing position size relative to ATR helps maintain consistent risk levels. Third, Traders use ATR in volatility breakout systems, where entries are triggered when price moves a certain multiple of the ATR from a reference point. Finally, ATR provides valuable context for overall market analysis, helping traders distinguish between low and high volatility conditions. Let's look at a practical example of using ATR for stop-loss placement. Here we have a price chart with an entry point at day 2. With an ATR value of 2, we can set a stop-loss at 2 times the ATR below our entry price. This adapts our risk management to the current market volatility. Before we conclude, let's review some key characteristics of the average true range indicator. ATR is typically calculated using a 14-day period, as recommended by Wilder, though traders may adjust this based on their time frame. It's important to remember that ATR measures the magnitude of volatility, not the direction of price movement. As a responsive indicator, ATR adapts to changing market conditions, rising during volatile periods and falling during calmer times. ATR values are always positive and are expressed in the same units as the price of the asset. Finally, ATR can be applied across different timeframes, from intraday charts to weekly or monthly analysis. Bollinger Bands are a popular volatility indicator that adapt to changing market conditions. They consist of 3 key components that work together to visualize price volatility. The middle band is a simple moving average, typically calculated over 20 periods, which forms the basis of the indicator. The upper and lower bands are calculated by adding and subtracting a multiple of the standard deviation from the middle band, creating dynamic volatility channels. Here we can see how Bollinger Bands appear on a price chart. The white line represents price, the teal line is the middle band, and the orange lines are the upper and lower bands. Traders use Bollinger Bands in several key ways to make trading decisions. First, they can identify potential reversal points when price touches or exceeds the outer bands, as price tends to return to the middle band. Second, they can signal overbought conditions when price reaches the upper band, or oversold conditions when price reaches the lower band. Finally, a contraction of the bands, known as a volatility squeeze, often precedes significant price movements, making it a valuable signal for traders. A key characteristic of Bollinger Bands is how they adapt to different volatility environments. During periods of low volatility, the bands contract, getting closer together as price fluctuations become smaller. During high volatility periods, the bands expand to accommodate larger price movements, providing dynamic support and resistance levels. This adaptive nature makes Bollinger Bands effective across different market conditions and timeframes. The Relative Volatility Index measures the direction of volatility on a scale from 0 to 100. RVI compares upward volatility to downward volatility over a specified period, typically 10 or 14 days. Let's visualize how RVI relates to price movements in the market. Below, we have the Relative Volatility Index showing the directional aspect of market volatility. The RVI oscillates between 0 and 100, with 50 serving as the neutral level. When the RVI reads above 50, it suggests that upward volatility dominates the market, indicating potential bullish strength. Conversely, readings below 50 indicate that downward volatility dominates, which can signal bearish market conditions. Traders use the Relative Volatility Index in several ways to improve their trading decisions. First, RVI helps confirm trend strength. Strong readings above or below 50 suggest the current trend may continue. Second, traders watch for potential reversals when the RVI crosses the 50 threshold from one direction to another. Finally, divergence between price movement and RVI readings can signal potential trend exhaustion and upcoming reversals. Historical volatility measures the actual price fluctuations of an asset over a specific past time period. Unlike implied volatility, which reflects future expectations, historical volatility looks at actual past price movements. It's calculated as the standard deviation of price changes, annualized and expressed as a percentage. The calculation of historical volatility involves computing the standard deviation of daily price returns over a specific look-back period. This standard deviation is then annualized by multiplying by the square root of 252, which represents the typical number of trading days in a year. Finally, the result is multiplied by 100% to express it as a percentage. Let's visualize historical volatility with an example price chart. Notice how historical volatility changes over time. During periods of low volatility, price movements are small and predictable. In contrast, during high volatility periods, prices move much more dramatically, with larger swings in both directions. The historical volatility line shows the 20-day rolling standard deviation of price returns, annualized. This provides a quantitative measure of market turbulence. Traders analyze historical volatility to identify unusual levels. Here we can see a period of low volatility with an HV of about 12%, followed by a spike to nearly 30% during the high volatility phase. Let's explore how traders use historical volatility in real-world trading scenarios. Traders use historical volatility in several ways. First, they compare current HV levels to historical averages to determine if an asset is experiencing unusual volatility. They also identify volatility regimes and shifts, which can signal potential changes in market conditions. Historical volatility helps traders adjust position sizing. Higher volatility often means smaller positions to manage risk. Finally, unusual volatility levels can highlight potential trading opportunities, especially for strategies that profit from expanding or contracting volatility. Let's compare historical volatility with implied volatility to understand their key differences. While historical volatility tells us what has happened in the past, implied volatility reflects market expectations of future volatility. Traders often compare these two metrics to identify potential mispricing opportunities. To summarize, historical volatility is a powerful tool for understanding market turbulence based on actual price history. It provides traders with quantitative insights into an asset's price behavior and potential trading opportunities. The Chaikin Volatility Indicator is a technical tool that measures market volatility by analyzing the spread between high and low prices. The indicator starts by tracking the price range of an asset, specifically the difference between the high and low prices over time. The calculation process involves two main steps. First, we calculate the difference between high and low prices for each period. Then, we apply an exponential moving average to smooth these differences. The resulting Chaikin Volatility Indicator is displayed as a separate line below the price chart, making it easy to compare price action with volatility trends. When the Chaikin Volatility Indicator rises, it suggests increasing market volatility, often associated with market uncertainty. When it falls, it indicates decreasing volatility, which may signal market consolidation. Traders use the Chaikin Volatility Indicator to identify potential market tops and bottoms. Let's look at a different example to see how this works. A market top often occurs when volatility reaches a peak. Notice how the Chaikin indicator reaches its highest value at the same time prices peak. Conversely, market bottoms often form when volatility is low before beginning to increase. See how the Chaikin indicator bottoms out just as prices find their low point before rising again. The Chaikin Volatility Indicator has several practical applications. Traders use it to identify potential trend reversals, confirm price breakouts, recognize market tops and bottoms, and as a tool for risk assessment. Standard deviation is a statistical measure that quantifies the amount of variation in price values. It measures how widely prices are dispersed from the average price. The formula calculates the square root of the variance, revealing the typical distance between each price point and the mean. Let's look at two different price series to understand how standard deviation works in trading. A market with low volatility has price movements that stay close to the average. This results in a low standard deviation value. The mean represents the average price, while the standard deviation bands show the typical range of price movements. In contrast, a market with high volatility has wider price swings, resulting in a larger standard deviation value. Notice how the standard deviation bands are much wider, indicating greater price volatility. Traders need to adjust their strategies accordingly in these conditions. Standard deviation has several practical applications in trading strategies. For position sizing, traders adjust their exposure based on standard deviation to maintain consistent risk levels. It's also used to detect volatility breakouts and identify changing market regimes, helping traders adapt their strategies. Standard deviation forms the foundation of many popular volatility indicators. Bollinger Bands directly use standard deviation to create upper and lower bands around price. Other indicators like the VIX, ATR, historical volatility, and Keltner channels all incorporate concepts related to standard deviation in their calculations. To summarize, standard deviation helps traders quantify market volatility. Higher values indicate wider price swings, while lower values show more stable price action. Smart traders adapt their strategies based on current standard deviation levels, adjusting position size, stop-loss distances, and profit targets accordingly. Implied volatility, often abbreviated as IV, is a key concept that sets options trading apart from other forms of market analysis. At its core, implied volatility represents the market's forecast of a security's potential price movement. To understand implied volatility, we first need to distinguish it from historical volatility. Historical volatility looks backward, measuring actual price movements that have already occurred. In contrast, implied volatility is forward-looking. It's extracted from current options prices and represents what the market expects to happen in the future. The level of implied volatility indicates market expectations about future price movements. Low implied volatility suggests the market expects relatively stable prices. High implied volatility, on the other hand, indicates that the market expects significant price swings, either up or down. Implied volatility is not directly observable in the market. Instead, it must be derived from options prices using models like the Black-Scholes formula. Trading platforms and financial services extract implied volatility from market data using various computational methods. Options traders use implied volatility in several ways. First, they identify potential mispricing, where IV doesn't match their own market forecast. They also analyze volatility skew, where different strike prices have different implied volatilities, often indicating market sentiment. Finally, traders often look for IV extremes. When IV reaches historical highs or lows, it may present specific trading opportunities. In summary, implied volatility offers traders a window into market expectations, helping them identify opportunities and manage risk in options trading. The Average Directional Index, or ADX, is a technical indicator that measures the strength of a trend, regardless of its direction. ADX is calculated on a scale from 0 to 100, with higher values indicating stronger trends. The key thresholds are 20 and 25. When ADX readings are above 25, this indicates a strong trend with sustained volatility. This is ideal for trend-following strategies as price movement has consistent momentum. Conversely, ADX readings below 20 suggest a weak trend and potentially choppy, unpredictable volatility. Markets in this state often have erratic price movements, better suited for range trading approaches. Let's compare how ADX behaves in different market conditions. In a strong trend, notice how the ADX value stays consistently above 25, reflecting the sustained directional price movement. In contrast, during a weak trend or choppy market, ADX values remain below 20, indicating inconsistent directional movement and unpredictable volatility patterns. Traders use ADX to determine if volatility is trending or random. The key advantage of ADX is its ability to differentiate between directional volatility, which offers trading opportunities, and non-directional volatility, which can be unpredictable. By monitoring ADX alongside price action, traders can make more informed decisions about which volatility-based strategies to employ and when to implement them. Volatility-based support and resistance levels adapt to changing market conditions, unlike traditional fixed price levels. Let's examine how price movements display varying levels of volatility over time. Traditional support and resistance levels are fixed price points that don't adapt to changing market volatility. When volatility increases, price often breaks through these fixed levels, triggering false signals. Volatility-based levels are calculated using a moving average as the baseline, plus or minus a multiple of a volatility indicator like average true range. The moving average serves as the center line, while the bands expand and contract based on market volatility. During periods of high volatility, these bands widen to accommodate larger price swings, reducing false breakout signals. When volatility decreases, the bands contract, providing tighter levels for more precise entries and exits. These dynamic support and resistance levels offer several practical advantages for traders. They help traders set more realistic profit targets based on current market volatility. Adaptive stop-loss levels reduce premature exits during normal price fluctuations. These bands better identify potential reversal zones where price might struggle, and they significantly reduce false breakout signals during highly volatile periods. Unlike fixed levels, volatility-based support and resistance adapt to changing market conditions, providing traders with a more reliable framework for decision-making. Volatility exhibits distinctive patterns across different market phases, each with its own characteristic signature. During uptrends, volatility tends to increase gradually as the market rises. This is often followed by a significant spike in volatility near the end of the trend, which frequently signals market exhaustion. In downtrends, volatility typically increases more sharply as panic selling occurs. These sharp volatility spikes often create larger price movements and dramatic sell-offs. Interestingly, extreme volatility peaks frequently mark market bottoms. During consolidation phases, volatility steadily decreases as the market moves sideways. This declining volatility creates a coiling effect where energy builds up. Remarkably, these periods of low volatility often precede significant breakouts and new trends. Understanding these characteristic volatility signatures helps traders identify the current market phase and anticipate transitions between phases. By recognizing volatility patterns, traders can adjust their strategies appropriately and identify potential breakout opportunities when volatility contracts. Markets display predictable volatility patterns based on time factors. Understanding these patterns can give traders a strategic advantage. Intraday volatility typically spikes during market opens and closes, creating what traders call a volatility smile, or J-curve. This pattern occurs because of increased trading activity and price discovery at the beginning and end of trading sessions. Let's examine how volatility patterns change throughout the week. Weekly volatility patterns show that certain days of the week consistently experience higher volatility than others. Mondays often see increased volatility due to weekend news and events affecting market sentiment, while Fridays can experience volatility from position squaring ahead of the weekend. Now let's look at how volatility changes throughout the year. Monthly and seasonal volatility patterns are well documented in financial markets. Certain months consistently show higher or lower volatility. October is historically known for higher volatility in stock markets, often called the October effect. This pattern is associated with historical market crashes like those in 1929 and 1987. Understanding these patterns has practical applications for traders and investors. Traders can apply knowledge of time-based volatility patterns in several ways. Options traders particularly benefit by timing their trades based on expected volatility patterns, potentially buying options when volatility is low and selling when it's high. Day traders can plan their entries and exits around known intraday volatility spikes, avoiding potential whipsaws at market open. And during historically volatile months like October, prudent risk management includes setting wider stop losses to accommodate larger price swings. By recognizing these predictable time-based volatility patterns, traders can prepare for regularly occurring volatility changes and adapt their strategies accordingly. Understanding these patterns gives traders an edge in navigating market volatility. Volatility-based position sizing is a powerful risk management technique that adjusts trade size based on current market conditions. The core principle is to adjust your position size inversely to market volatility. This means taking smaller positions when markets are highly volatile and larger positions when markets are calmer. Let's visualize two different market environments. The teal line represents a period of low volatility with smooth price movements. The orange line shows a high volatility period with erratic price swings. Let's examine two specific periods: a low volatility period with an ATR of zero point 0.5 and a high volatility period with an ATR of 2.0. Position sizing can be calculated using the ATR. The formula is simple. Position size equals risk amount divided by ATR times an ATR multiple. In this example, with the same account size and risk percentage, our position sizes will vary dramatically based on market volatility. During low volatility periods, we can safely hold 2,000 shares, while during high volatility, we reduce to just 500 shares. Let's see the impact on risk exposure. With fixed position sizing of 1,000 shares, your risk varies dramatically between low and high volatility periods. But with volatility-adjusted position sizing, your risk remains more consistent regardless of market conditions, helping you maintain better risk control. To summarize, volatility-based position sizing offers several key benefits. It maintains consistent risk exposure across different market conditions. It helps preserve capital during turbulent markets when losses can mount quickly. It allows you to maximize opportunity in stable market conditions. And ultimately, it creates more predictable trading outcomes over time. Volatility indicators behave differently across various financial markets, each with its own unique characteristics and patterns. In Forex markets, volatility is often linked to economic data releases and shows distinct patterns based on global trading sessions. Forex volatility typically peaks during session overlaps, particularly when European and US markets are simultaneously active. Major economic releases like non-farm payrolls can trigger significant volatility spikes. Cryptocurrency markets exhibit substantially higher baseline volatility compared to traditional markets like Forex and stocks. This requires traders to adjust their volatility indicators accordingly. Commodity markets often display predictable seasonal volatility patterns, especially agricultural products that follow harvest cycles. Supply disruptions can cause sudden volatility spikes that require special handling with indicators. Understanding these market-specific characteristics helps traders apply volatility indicators more effectively. Each market requires different parameter settings and interpretation approaches. By tailoring your volatility analysis approach to each specific market, you can significantly improve the effectiveness of your trading strategies across different asset classes.